Alright, I wanted to redo this video. Actually, I had a friend say that the last video on the CAD yen pair actually sucked. So I don't want a sucky vid, so I'm going to redo this vid and try to explain it a little bit better than I did before. This is the Canadian yen pair. I took this trade on the, I think it was the 20th or the 21st of September. And a couple things about this trade caught my eye initially. When I look at my charts, I generally scan the charts on the daily first. I'm looking for something that has somewhat of a trend or some extreme maybe, or some price action that really gets my attention. So what I do is really quickly scan the dailies. And what I saw here was this downtrend. If I can show you this downtrend in the price, but this consolidation area really caught my eye. This sideways consolidation here, and how tight it was. This is a daily, and it's about a 200 pip sideways consolidation between 77 and 79. You see right here. And my thinking here was that if it breaks this sideways consolidation to the downside, that it's just going to be an avalanche. You know, sellers are going to come in, and it's potentially going to be a decent trade. My first question was, how much room do we have to the downside for this thing to travel? So what I would typically do in this situation here is pop over to the weekly and kind of measure this thing out. See, here we have another weekly huge sideways consolidation. It's been going sideways here for a long time on the weekly, but what I really caught my eye was this low down here, this zone down here. I see that we have lows here that have been broken on the weekly, and we have these lows down here. So this is like a target area for me. So I'm thinking if these lows are broken here, then the next stop is going to be these lows over here. And as you can see, we've got 450 pips, 500 pips maybe as a first stopping point, and we have one low down here that's 780 pips, say 800 pips. And so what I'm thinking is that if we can take a portion of that, 400, 500 pips out of there, and we've got ourselves a really great trade opportunity. So that's kind of what I'm going on here. So I know there's room for this to move down. I know there's room for the price to move. It has broken support, and it has crossed. This is my Fozzy indicator here. The Fozzy is really just an RSI, and it has overlaid over it. We have the moving average of the RSI. So the blue line is the RSI, the red line is the moving average of the RSI. When that moving average of the RSI crosses the RSI, it shows a weakening or strengthening in the price in that general direction. I prefer to see them in the extremes here, but you can't discount them when they're not at an extreme. This is an oscillator, so I mean the oscillator could be at an extreme for a really long time. If it's really trending hard one way or the other, you can't really use the extreme. The indicator becomes less valid. It's more valid for oscillating and turnarounds. I like to see it at an extreme, and I take a note of when that cross occurs. And let me just mark that with a line here. This makes it easy to see on the 4-hour chart, because what I'm going to do is I'm going to use the 4-hour as a trigger chart, and I'm just going to let me see if I can get this where it crosses right there. So this is where it really crosses, and it has not broken support here, but it shows that it's kind of moving towards the bottom of this channel. And if we pop over to the 4-hour chart, what we're going to see here, and the red line, this is where we first show the weakness of the cross of the Fozzy, the RSI moving average against the RSI, and we're moving down. And what I'm going to look at, since I'm playing a Donchian channel breakout, Donchian channels really just mark the highs and lows. I've got this set on a 20 period Donchian channel breakout, so it's just marking the highs and lows, the most recent highs and lows over 20 period time frame. And I'm just looking for the break of that channel. And you want to use some common sense in here too. You want to use support resistance areas. You want to use your price action. You know, price action is king, but we're using this breakout of these highs and lows as an entry point, supported by price action and everything else. So I've marked my entry points here. I actually got into this a little bit late. If I were getting into this, if I had been vigilant with this, I would have gotten in somewhere around here, 76.80, something like that. I like to go about 20 pips below the round numbers. That way I give it a little room, and even then sometimes it'll bounce back above. There's no guarantee that it's going to continue, but I got in a little bit late. So we have lows here as well, marked by this Donchian channel line, but I got in at this green line. I got in my first unit, which was around 76.41, I think was the actual price that I got in. And here's how I work this. I've been taking the ATR, either the 1.5 times to 2 times the ATR, whichever one makes sense. And what I mean by that is I'm looking for some logical place on the chart to put my stops. Okay, I'm going to place my stops 1.5 times to 2 times the ATR. You see here's the ATR listed on the chart. I also have the Donchian as an indicator, supporting indicator, but I'm not going to go into that right now. But here's the ATR listed on my chart, 52 for the 4-hour period on this Canadian yen pair. And what I'm going to do is measure out 1.5 times to 2 times the ATR, so 75 to 100 pips, basically. So, but I'm going to look for a logical spot here. And the first logical spot that catches my eye is, of course, above the round number. The round number seems to always be kind of a natural sticking point for price, but maybe a high as well. So if I can get above or around a support resistance point and at a high or a low for the price that makes a resistance point, then I'm going to use that. So my initial stop would have been here. Now that's going to be, my first unit is 2 lots. You know, that's 100 pips times 2. That's a 200 pip risk. And I try to keep my risk in my account per trade 1 to 2% of the entire account value. So my risk per trade is going to be, or per this trade, is going to be 200 pips initially. Okay, so my stop goes there. My stop goes behind the highs right here. This little cluster, this little consolidation area right above the round number. That's 100. That's 2 times the ATR. And that's where my trade goes. That's where I enter. I almost exclusively use these buy stops and sell stops. I set it and forget it. So the buy stop goes in or the sell stop goes in, I can walk away from the trade. Now if it doesn't get filled, then I have no worries. I have no risk whatsoever. Rather than just pulling the trigger, I like to put the entry order in so that I can really just let the trade go. If I get filled, that's great. If I don't get filled, then I'm not at any risk at all. And what I'm doing here with my entries, I'm scaling into the entries. So I like to scale in if there's enough room to the upside or the downside. I like to scale in 3 times. I'm using 3 units. Each unit is 2 lots per unit. So my maximum load is going to be 6 lots total, scaling in every ATR. So if the ATR here is around 50 pips, I want to place my next entry order right around 50 pips. So what I'm doing here, my next entry order was at 75.80, and you have to use some logic with this as well. Keep in mind that the round numbers are kind of natural support resistance points. You put your entry points above or below these support resistance points, and what I did here was put this entry right below the round number of 76 and put it 20 pips below at 75.80. Now what I do at this point when scaling in, I'm going to take this stop that I originally placed back above these little highs here. That was my original 100 pip stop, or 2 times the ATR. I'm going to take that stop and I'm going to move it down here to my original entry price. That's going to move that first lot to break even. Now my second lot, I'm going to put the stop right at the original entry price, and I'm going to have at that point 60 pips at risk, just above the ATR, right around the ATR. And so what my risk at this point is, I'm break even on the first pair. I'm 60 pips at risk. 6 times 2 lots, that's 120 pips right there. So I still have risk in the trade, not quite as much. It's 120 pips. So if I get stopped out, I'm stopped out. I have 120 pip loss. When you're scaling in like this, the idea is that you keep your loss as low as possible while scaling in. The thing that happens is that you're going to increase. A lot of people like to move their stops to break even as soon as possible so they have no risk. When you're scaling in like this, what you're doing is lengthening the time that you have that at-risk amount. So the time, you don't have to risk more. You know, I still have 1 to 2% risk in this account. However, the amount of time that I'm taking on that risk has been increased because I'm continually putting on these units as the trade advances. This trade seems to be moving with some momentum. You can see these big candles. They're all bearish candles. This thing is just, like I said, is like an avalanche falling out. So what I've done here, rather than wait for the full ATR, I just went ahead and when I filled this, I went ahead and put another trade in at 75.40. I figure if it stops at the 75 level here, which is a big round number, bounces here, at least I'm going to take 40 pips out of this particular unit, and no harm done. So once I place this third unit on, and this is the last unit I'm going to place on, once I place this on, I then take each subsequent stop and I move them to break even. So my first stop is going to come down, my second stop is going to come down to the entry level of the second trade. So I've then got a 40 pip stop on, and I've got 3 lots on. So what I'm going to lose here, what I have at risk here, is 40 pips or times 2, or 80 pips total. So I still have risk in the trade, but now I have 6 lots working for me on the upside. So what I'm doing here is taking the risk and minimizing the risk, but letting the lots work for me. So when you're wrong, yes, you're going to get stopped out. I hate that term wrong. Let's say when the trade's not profitable. When the trade's not profitable or it goes against you, yes, you're going to get stopped out. Yes, you're going to lose pips. You're going to lose money. That happens. But when it goes with you, you're really compounding the amount of money that you make. It is really going to make the trade profitable for you. This trade was a total chart move added together was about 535 pips times the 2 lots that I put on for all six lots. It came out to about 1,070 pips for the entire trade, total pip move. So I mean, so the gain was really quite huge, and you can see here. I'm gonna show you with this red dashed line right here is where my stop was. So as soon as this thing reaches, moves below the round number, it actually moved down here. I'm moving the stop down from all 3 entries. All 3 entries are moving down as the price goes down. So I'm locking in profits all the way down. And once it gets down here below 75, I've got profitable trades in all 3 of my entries. All 3 units, 6 lots altogether, have become profitable. And now I can sit back and relax. I have nothing to worry about. I've made a really good amount of money on this trade, and I can just sit back and relax. I don't really care what happens at this point. I've moved my stop down to, I believe it was 74.50. All 3 stops are at the same level, and now I'm just going to let it go. I'm not going to worry about it. I'm going to get stopped out of this trade. If it continues to move down, I'm going to keep moving the stop down. If it does not, then it's going to take me out at almost an 1,100 pip profit, and I just can't. There's nothing that I can see bad about that. But and that's where it was. That's what happened. It came down here, it bounced up, and it just barely rose above my stop, and it did take me out. I was looking at the trade, and realizing that I think it still has some room to move. It seems like it may have stalled out here. If you look on the daily, it seems like it may have stalled out here a little bit. And it still has room to move. If you look on the weekly, you can still measure this out. If the price is right here, you know, these lows will take you down about 350 pips. If you measure down to the very low, that's still 600 pips. So this thing has possibly can still move lower. And if that's the case, what I did was I put an entry right below. This is the Donchian channel right here. I put an entry, another sell stop right below here for 1 unit or 2 lots. And there's my stop. I put my stop right above these highs here. Now it may not move lower. It may not move lower. Let me see what this is. Oh yeah, this is about 100 pips. So it's about the same. So I try to, it's 2 times the ATR, no more than 1 to 2% of the total account value, and I try to find a logical point, high, low, round number, something like that, to place the stop. And that's pretty much the way that trade worked. That was a really successful trade. And if I don't get filled on this, no worries. I haven't put anything to risk. It's just kind of a set and forget. If I do get filled on it, it may go another 600 pips. So we'll see, and I'll just do that process over again, where I scale in and keep my risk at 1 to 2%, scale into the trade, and keep moving the stops. And that's it. That's my CAD yen trade for the week.